first I wanted to see what objections you all are hearing as it comes to interest rates and finances.
Too high.
Yeah.
Too high. Yeah.
Anything other than rates?
They don't see anything they wanna buy.
Do what?
They don't see anything they wanna buy.
Okay, well,
Not a
yeah.
big car.
What's wrong?
I don't know, I'm trying to help.
That's okay, yeah, we'll get to a couple more. And really, a lot of it, we're gonna just be talking about ideas. So, it's gonna be interactive when we get to the part actually discussing the objections, how to handle them, and kind of what we can do, as loan officers to help you guys through that. So, let's see, I don't know how to get to the next slide. There we go. Couple things we're gonna talk about. One is the cost of waiting. Can anyone tell me, how do you pitch it to your buyers or your prospects when they, say they're gonna wait? What do you tell them about the cost of waiting?
When rates come down, it'll be a lot more competitive. It'll be harder to get the house they want because everyone else will be buying at the same time.
Yeah, absolutely.
Prices keep going up.
Yeah, prices are expected to go up, exactly. Obviously, we're gonna talk about objection handling, and really, the way to handle most any objection is just providing comfort, providing a plan, being a person of understanding, and building that trust with your client, especially when it comes to finances. And because that involves, your initial conversation with the buyer and the loan officer, or maybe a financial planner, it really is important to communicate and really be that resource and that personal comfort for them. We're also gonna talk about increasing purchasing power, and there are strategies behind that. So it's not just, this first time home buyer has a $40,000 salary and is not gonna be able to buy anything because rates are so high. So let's get to the bottom of it. Let's figure out, okay, well, what payment can they afford, and what can we do to help them get there, even if rates are at 8%. So that's kind of what we're gonna go through today. Here's a chart for average interest rates in the a 5-year increments from 2000 to 2020. Now, I don't really love looking at this because you can see, in 2000, throughout the year, this is the average over that year, we're similar to where we are today, so that's a good thing. But looking at a lot of folks in the market, we've got a lot of first-time home buyers, or even young families that are repeat buyers going from that, they're stepping up, they're having kids and things, and they're looking and remembering rates that were 6, 5, 4, 3.5%. So the folks that can say, oh, my interest rate was 10%, 15%, things like that, a lot of times they're not our buyers that we're trying to get off the fence. And so when we're talking about historic rates, it's not applicable to someone like me or Kevin or Sarah or folks that are growing our families and are trying to get up into those next level homes. And so it's hard to really compare and say, hey, historically rates are low. They are. Historically, they're probably middle of the road. I wouldn't say they're still low. But one strategy I try to stay away from is saying that, hey, well, so-and-so had a rate of 15%, because the market has changed a lot since then. The market has changed a lot since 2020, and we're only 3 years away from that. So, do you have a question?
What about, approaching it, would you approach it, recommending like a short-term ARM then? Like 5-1, something like that
Yeah.
has a lower rate?
Yeah.
For the first-time home buyer.
Absolutely. The ARMs are out there, and what we're seeing with ARMs, as well as several other product mixes, is discount points. Because the hard part is the market is so elevated, and it's happened fairly quickly, that offering an ARM at a lower rate is not, there's no cost advantage there for the lender. And so we're seeing right now a lot of ARMs that do come with discount points. Now that doesn't mean it's a bad option or it's a bad rate, just means there's a higher cost to get in there, and there may be other opportunities to get a similar payment or a similar rate at less cost if we look at some of these other strategies. So the ARMs are definitely an option, but it's hard for us to come by strong ARM products right now. So really, I try to stay away and talk about what's relevant and what the folks that we're talking to, we're trying to get off the fence. What's the data that they've been hearing in the past couple years, in the past 6 months, in the past 3 months? Because a lot has been changing, and being armed with data and facts to help them get through what we're seeing now, I find is more helpful than showing them or talking to them about these old rates that hopefully we see again, but we may not see again. So I just wanted to kind of put that in perspective. It's been 20 years since we've been where we are now, and you know, there's really no point in talking about 20, 30, 40 years ago when it comes to the folks that weren't even alive then, and they're a lot of our client base right now. So what is relevant to them is trying to explain to them where they might be in 2 years from now. So some of these numbers were put together a few weeks ago, so unfortunately we are a little bit higher than 7.5% right now, but this is just a tool to help explain what these scenarios could look like. So you'll see, let's say somebody buys today at 7.5%, these are all 30-year fixed, 20% down, they don't include taxes and insurance, so this is just your principal and interest payments. So you've got your $500,000 purchase price, monthly payment of $3,220, 20% down and closing costs included, about $112,000 out of pocket. Well, in 2 years from now, we don't see rates change at all. We do know what? Prices are going up. So you've got the same house, $550, rates the same, you're paying over $300 more a month, and you're paying more out of pocket because that 20% down is now based on $550 instead of $500. So let's say nothing changes, you're already worse off financially, and you could have had 2 years where, you know, you're building equity. So then let's say you wait 2 years and the market does improve. All right, well, you're paying $550, your payment might be a little bit lower, but you're still coming out of pocket more money than you are here. So instead, if the rates get better, well, let's just refi and have an even lower payment than what you would have if you didn't buy today and bought here. Whereas if you bought today, then you refi, your payment is still lower, and you're out of pocket still $10,000 less. Then worst case, rates continue going up. You've got $550, 9%, your payment's way higher, almost $750 higher than here, and you're out of pocket more. So having these numbers and having this information for your clients is super important because, I mean, like we said, the one thing we can count on, we pretty much know, unless something unforeseen happens, is that the values of these homes are gonna continue rising. It might be slower than what we've seen, but it's gonna happen over the next 2 years. And so this is the window of time that these families might be saying, hey, well, we just got married and we're having our first kid, we're busting at the seams, but the rates are too high. All right, well, in 2 years, when you have your next kid, what are you gonna do? So illustrating to them, hey, you know, the rates might be high, but we gotta put you in a position because it's gonna be worse for you and your family financially if you wait. And so they might be able to upgrade to that next home, and then their home that they're currently in, the first-time buyer can get into. And then when we talk about first-time buyers, it's more strategy about saving and other things, really just to get them qualified. Do you guys have questions about any of these numbers? No? Looks good. So, and Nathan, we've got a flyer we'll pass around too. This is just another tool that you can keep handy. And this is a 10% down scenario, same price and same scenario with the $550 and the interest rate. But it's just something you can have on hand as a tool just to reference. Because really, you know, while it might not be comfortable and it might not be the numbers that people want to see, it is still a better time to buy today than it may potentially be in 2 years. So something to keep in mind. Now,
Do you need more? We have extras.
Thanks.
I think there probably should be enough, and I can email it out if somebody doesn't get one.
Electronic?
So, and that, again, those numbers there, they don't include your mortgage insurance, taxes, or homeowner's insurance. So they're not payments, you know, that we're promising to buyers or anything like that. It's just for you to see the difference in, you know, today's market and what it could potentially look like. So getting into the objection handling, really all of this comes back to preparing and having a plan. And so this has been drilled into me by my dad my whole life, but by failing to prepare, you're preparing to fail. And I think when I was like in high school, I might have had it written on my bathroom mirror because he had told it to me so many times. But it's true for us and for our clients and our prospects. So instead of hearing rates are too high and being like, there's nothing I can say, well, what you can do is be a resource. You can help them prepare, you can help them plan. Even that family that's busting at the seams with the one kid, and a couple years they have 2 kids and they're all sharing a bedroom, even if they're not able or willing to buy in 2 years, having you in their corner is gonna be important because they're gonna buy someday. And so that's kind of what we have to figure out how to do, is how to be that resource for them, how to make them comfortable. So when they give you that objection, the first thing you need to do is empathize with them. Yeah, rates are high, I totally understand. But then put the ball back in their court and try to figure out what's really the problem. So rates are high, there's nothing we can do about it. But what can we do and what are you waiting for? So you come back to them with a question. You can kind of figure out what's the real issue. So rates are too high, their payment's $1,200, and they don't want a $3,500 payment. Okay, when you ask them more questions, they can explain that to you, and then we can enter into strategy and make a plan, figure out, well, how much do we need to save? How much do we need to put down? In this market where there's maybe a little less competition because of high rates, can we strategize and get some seller credit for a 2-1 buy down? There's all sorts of things that we can do and open up that conversation with the realtor, with the buyer, with the lender, rather than just hearing the interest rate objection and being like, all right, I'll call you when rates come down. We don't know when they're coming down, and we don't know when they do, how quickly it's gonna happen. And so they might think 8% now, okay, well in a year, maybe we're at 7%. Is it really that much different in payment, and it's worth them paying $25,000 more for a house than they did today? So because of those things we can't predict, we really need to be in front of them and make sure everyone that you're calling has a next step. You're not hanging up the phone without a follow-up, without an action item for you or for them to do, to put them in a place in 1 year, 2 years, 5 years for them to buy. If you hang up the phone and they're just like, yeah, now's not the time, all right, well, when is the time? What are they waiting for? So looking at some of the objections, rates are too high, that's what we get. So responding with, I hear you, there's that empathy, and then saying, well, what interest rate would you be comfortable with? Could they even tell you? They don't know the numbers. And even if they do know the numbers, all right, well, 3%. Okay, well, when are we gonna get to 3%? We don't know. So then it's sort of like, okay, well, there's no light at the end of the tunnel when they say rates are too high. How are we gonna combat that? So then we gotta figure out, all right, well, rates might not be dropping anytime soon, but there are ways to purchase within your comfortable budget. We gotta figure out what that is. Can I connect you with the lender? So they might not have any idea what their payment is, what they can afford, what they can't afford until they look at the numbers. But if we have something in front of us and they're saying, you know, the first scenario I gave you, 500 with 20% down is putting you at, I think, 3,200 a month. So if that's too high for them and they're currently paying 1,800 a month, well, what they need to be doing is saving the difference. Pretending to live off of a $3,200 payment, or even let's say 25. Let's say 2,500 is the most they want to pay. They can't just be sitting here waiting for rates to come down. They need to be saving the difference in what their future payment's going to be and what their current payment is. And it does a couple things. It creates, and we'll get to this kind of on another slide, but it creates a built-in savings, and it also helps them live on that budget and set themselves up to purchase when the time is right. You can't force them if they're really not motivated. If that family of 4 wants to stay in 1 bedroom, you can't make a move. But what you can do is arm them with the facts and arm them with the information they need to make the right decision for them. And so that's what we want to do with these objections is, you know, okay, we're waiting for a better market. Well, what's that? You know, I mean, some people might say it was a better market when things were moving faster and rates were lower. But at that time, you were paying $50,000 more and had to waive appraisal and had to waive inspection. There was no protections for the buyer. Is that a better market or is this a better market? I mean, what is better? And so asking them, okay, well, what specifically are you waiting for? And is it something we can control or is it something we can't control? And then the answer is probably something we can't control. So let's look at what we can and let's look at ways to get them into a house sooner than what they think, or in their ideal timeline, but we're at least walking through this journey with them. We're not hanging up the phone and saying, it's a bad market, we gotta wait till it's better. We're gonna help them get there. And so, a response to this could be, we do know there's a cost to waiting, right? So what is a better market? What are you waiting for? And would you be open to looking at what the cost would be in today's market? We can create a financial plan to help you get there. So all of this, like I said, is really just communication, providing empathy, and making that connection with the buyer. Another one is they wanna pay off debt first. Well, that's great. But we just had a scenario where somebody spent $120,000 paying off debt. They paid off all the wrong stuff, right? They paid off things, they spent money on things that didn't move their debt to income ratio the way we needed it to. And that's great, they're 120 less in debt than they were before, but it didn't impact their qualifying the way they had intended. And so instead of paying off a timeshare that was $1,200 a month, they paid off a couple cars that added up to be $700 a month. So when you think at that, when you look at that, we're $500 different in what they could qualify for. And so when they say that to you, and then they say, oh, well, we're just gonna pay off debt, we know what we're doing. How do we know? Especially when rates are so high, they need to really go into it with a strategy. And they need to know, you could pay off this, but it's only gonna give you $50,000 more in purchasing power. You could pay off this, and it'll give you $100,000 more in purchasing power. And you're looking at the same cash flow, what they're making and what they're paying out in liabilities, but we're structuring it in a way that actually helps them in today's market. And then wanting to save more, another financial obligation. So how, getting to that, so that could help you reach a comfortable payment if you have a bigger down payment, but do you know how much you're gonna need? And a lot of people don't know. They might say, well, we think we need to save 20%. And that's awesome. If that's really their goal, we can help them put together a plan and figure out how long that's gonna take. But 20% of what? Is it gonna take 2 years? Because then you're paying $50,000 more for a house. Or 5%, let's look at how we can structure the mortgage insurance to make it comfortable for them and not have to have the 20% down. So asking them, do they know how much they need to save? And is having $5,000 more even gonna change their monthly mortgage payment the way that they think it is? Some people are very surprised when they say, oh, well, I can pull $10,000 from here and put this towards the down payment. That's awesome. But is it necessary if it's gonna be $35 a month? And for some people it may be, they may want that. But for others, they may be like, I'd rather have that in reserves and pay $35 a month higher and just skip the drive-through a couple of times, So arming them with knowledge, again, is really all we can do, because some people think they know, but they really don't. And that's what we're here for. Any other financial objections or any other ideas and responses to some of these that I put up here?
I've been saying to people, if you're not in the market, you can't take advantage of the market. It's one thing that I've used a few times, so people know you're waiting. It's just tough. It's very difficult to time the market, and if you're not in it, then you can't really take advantage of it.
Yeah, absolutely. And Kevin is a great example of how to handle these objections and what to do. We've been working with some folks that sold their house almost 2 years ago, I think, and every couple months we're kind of talking to them, updating numbers, they're seeing what's on the market, they're seeing the change that the market has made in 2 years. But to my point, Kevin is staying in touch with them. Kevin is not hanging up the phone without a next step, whether it's for the customer, for the lender, or for himself. And that's keeping them on the line. Kevin's their trusted source, and when they buy, they're gonna use him, because he didn't hang up the phone and say, rates are too high, I'll call you when they're 6%. He's staying in front of them, and he's really building that rapport and that trust. Anybody else have ideas? Yeah.
This might not be a very good idea, it might not be that fun, but I always say, will your mama give you 100,000? Because you never know who will give them the money, and we're seeing lots and lots of cash, so I just think as realtors, sometimes we're a little hesitant to ask them to get a gift from their mom, but I kind of blend that in.
Yeah, I had someone call me when I was on the way over here. Hey, some things have changed, and I talked to her last Thursday. Some things have changed. My mom gave me a gift to pay off the land loan that we have. So now, instead of qualifying for 450, they can qualify for 550. And so that wasn't really, they were good with 450, they still may not spend more than that, so it's not really something crazy that's gonna change their home search. But it just goes to show how quickly circumstances can change. And she didn't even need to call me and tell me that if they're not gonna shop higher than 450, but because now I know that, we have a little bit more to work with. And I can structure some numbers and be like, you might not wanna go more than 450, but if you did 475 because now you can, this is what the difference is monthly. When they get into a competitive situation, we now have that ability. And so, whether it's a gift from family or whether it's 15 cents an hour pay raise or something like that, that they may think is not significant when it comes to qualifying, being in touch with them and understanding all of the changes that are happening in their life and in their financial picture is super important because it could put them in a position that they didn't even realize. And so that's a part of staying in front of them too. The folks I was talking, referencing of Kevin's folks, you know, when I talked to them, they sold their house a couple years ago, but they haven't saved really any than the proceeds of their house. And so I had to have a talk with them and say, hey, you're not paying any, or you know, what you're gonna pay versus what you're paying now, we need to be saving that difference. And we, as if, you know, I'm feeling it, but you know, I want him to understand that had he been saving for 2 years, he would have almost $50,000 more than what he has now. And his payment would be way more, you know, he'd be way more comfortable with his payment if he had been doing that. And so really, people saying it's a bad market or rates are too high or want to pay off debt, they have to be doing something to put themselves in a better position. And we have to be those encouragers. Any other ideas for responses?
Are those the objections you guys are seeing for the most part, hearing for the most part?
Financial objections at least, yeah. So, and here, the next part, increasing purchasing power. So I've touched on this really throughout the whole presentation, but saving, increasing income, debt structure, improving your credit score, getting a gift. There are several different things we can look at that are in our control, or at least, you know, we can make a plan to take action rather than waiting for a better market, waiting for interest rates to change. Those things we have no control over, so that they don't qualify for what they want, or if they do qualify, the payment's too high, we can look at ways like debt structuring to figure out how to get their cash flow in a comfortable place. So for savings, how many of you have a budget? How many of you reference your budget at least once a week?
Me or my wife?
So, how do you know some people can look at their budget once a month and just kind of see where the numbers shook out and readjust next month. But for folks that are trying to save with a purpose, they need to be referencing their budget. They need to make sure, hey, this weekend we ate 4 meals out for a family of 5, and we're way over budget, and it's only the first weekend of the month. What are we gonna do? How are we gonna save? The first thing that they're gonna do, they're gonna take away from their savings. And all that's doing is cutting their dreams of buying a home. So they really need to be educated, and they need to have accountability of checking their budget. What do they have? Is it an app? Is it written? What works best for them? And sticking to it. And so that is the first thing. Even if someone is in the market ready to go, but they're not finding the right house, this is still something that they should be paying attention to, because it's gonna put them in a different financial position when they actually get under contract. So it doesn't really matter who you are, and I'm not gonna get on my soapbox here because my husband will tell you I'm obsessed with our budget. You should have a budget, and you should be looking at it, and you should be saving, even if it's not for your house. Maybe it's for your boat, or maybe it's, you know, to send your son to college, or, you know, all those things. It takes strategy and it takes planning, and that's what we're gonna help our clients with. So knowing your goal. So the budget is important because you have a goal in mind, and some of those goals I just mentioned, but sticking to it. And if you need to have a vision board, or if you need to have a, you know, a mission statement or something like that, and maybe kind of figure out, that's a way to get a little personal with your buyers, kind of figure out what drives them and get them motivated to save, to look at their budget. to get to where they wanna be and not just say, no, we're gonna wait. I'm not the most motivational person, and I'm not a realtor though. You guys are better talking to people than I am, so I think you can maybe get creative on kind of what gets people excited, what makes them happy, what drives them. So I touched on this, saving the amount of your potential mortgage payment, and this could reduce payment shock. So payment, you guys know what payment shock is?
What's payment shock?
What's payment shock?
Maybe a little higher than we were expecting.
Yes. More so.
When you get to your first payment, you go, oh my gosh.
So payment shock is the new mortgage payment is higher than what you're currently paying. So we've got 100% payment shock when you've got somebody who's living rent free with their payments, with their parents, right? And then let's say they're paying $1,200 now, and their new payment's going to be $300. There's still some payment shock there, right? And so when we look at that, that's also something that underwriters will look at too. If there's 100% payment shock, then there's more risk to that loan than other loans where they're going from $4,000 to $4,500, that sort of thing. So using this built-in savings plan can kind of help reduce payment shock in the eyes of the buyer, right? So they're living off of making a $3,000 payment, mortgage is $1,000, saving $2,000. When they get into that house, that mortgage payment is not going to scare them. And because they've been doing this for several months, they have much more down payment. So that's what's called also a sinking fund. A sinking fund is you have a goal in mind, you know it's going to cost you $50,000. You put money into it, knowing that once you reach that, you're gonna use it for what you're intending it for. So doing this kind of savings plan, establishing a sinking fund for your down payment, which a lot of folks do, but they don't commit to it because they don't follow their budget, or they don't know how much they need to be saving. Those are all things that we can help them with. Increasing income. This can help folks that maybe have the ability to ask for a raise. They haven't gotten a raise in a couple years, or they maybe get a raise every year and we know that that's coming in January. We can still strategize and put together a plan today, look at numbers today, and then when they get their raise, that's what we'll qualify them on. At least they've got a couple months to digest the numbers, a couple months to save more than what they were going to save if they hadn't talked to us in the first place. So raises are obviously the first thing you think of, also a side job. Then I put here adjusting business expenses. I've got a guy I talked to last week, and his business gross is like over $1 million, and he doesn't have, we can't use any income, not a penny, because of how he files his taxes. And that's a good strategy when you're talking about the accounting world, when you're talking about qualifying for a mortgage. He didn't understand why we can't, why we don't have any income to work with. And so while it might not be great because you don't want to pay more taxes, when it comes to qualifying for a home, because we are nearing the tax period, it's possible that we could discuss and the people could look at their taxes and maybe take less deductions just so they can qualify this year and maybe get back to normal next year. There are things that we can do to, get some folks that make a lot of money but don't have anything to show for it in our eyes, right? We can work with them a little bit and strategize with the CPA as well. So, all of this is ultimately lowering the DTI or making room in the DTI to buy a higher priced home, take out a higher loan, and creating positive cash flow and leaving room for some more savings. So a side job, whether it's hourly or cutting grass or whatever, we can't really use it for qualifying, but they could be doing this and all of that money is going into their savings for their down payment. Or maybe they want to put it into savings just for the sole purpose of buying discount points or paying single premium mortgage insurance or doing things that are going to reduce their payment by a certain amount that's over and above their down payment. There's ways that we can kind of make that impact and talk through that with the buyer. Debt structure. So obviously you think eliminating liabilities, paying off credit cards, paying off auto loans, things like that. But really what I look at is determining the best use of funds. If somebody comes to me and they've got $80,000 to use towards a transaction and we're capped at 500. Well, on the chart we had up here, the difference between 500 and 550, the same interest rate is about $300 a month. So if we're capped at 500 and they're like, we really need to go a little higher, I'm gonna say, okay, well, why don't we reduce your down payment a little bit and let's pay off this car loan that you've got 18 months left, $500 payment, and now we can qualify for 550. So looking at things like that, it's not so black and white of, hey, I've got 20,000 to put down, I've got 5% to put down. It's how can we really improve their cash flow so that they're getting into a home or they're more competitive in the market than they were before we looked at it. So I say more bang for your buck. You know, if their car payment's $500, but the difference in 50,000 is $300, well, you pay off that car, you qualify for more, and you still have 200 left. So we could qualify for even more, or we could save it, or we could do, so, those are the things that people don't think about. And ultimately lowering the DTI, and by doing some of this debt restructuring, could potentially increase their credit score. So that leaves me with the last one, improving your credit. There's lots of ways to do that and lots of reasons we do that. Some folks, we might need to improve from a 560 to a 600 or a 640 or, you know, whatever we need to do to qualify for that program. But others, I just had somebody that we rescored a week before closing from a 732 to a 760 because it impacted their rate pricing by 0.5%. And that's not 0.5% interest rate, that's 0.5% in cost. He was buying discount points. We were able to get his score up, and he saved on a $600,000 loan, 0.5%, that's $3,000. And so we're able to do these things to help out-of-pocket costs, help interest rate pricing, not just for getting somebody, you know, a 640 so they can barely qualify. So, yeah,
Did that credit score cost your borrower any money?
no, other than paying off the credit card he needed to pay.
Right.
But yeah, we do credit rescores at no cost to the borrower. And again, that was a week before closing. We have been strategizing, watching for, hopefully, we were gonna be able to renegotiate and float down if the market improved. The market didn't improve, so we said, all right, you gotta bite the bullet, 6,000 on your credit card, you know, and he had the money, but, you know, you're either paying 3,000 in points or 6,000 on debt you already owe, that, you know, he's now eliminated that payment, and it's overall a better cash flow for him. So yeah, no cost to the borrower, and ultimately he ended up in a better position. And the loan was fully approved, and we were still able to do this for him. So, you know, that just tells you we're looking and we're watching, and we're accessible down to the wire. And that's what's so important. Why it's so important to work with a lender that you know and you can see face to face and you can call any time of day. And obviously improving your credit can lower your DTI in some circumstances. Sometimes improving credit actually means opening a credit card or opening a credit account for someone who has limited credit history and not enough data to establish a score. So lots of ways. One thing, a gift is a way to increase your purchasing power. And if folks apply with us, their credit is good for 120 days. Their app with us in our system is good for a year, but we have access to that data beyond that we could pull, start a new file, and just get updated information. So for folks that think they're not ready for a while, we still, you know, it's not like they're gonna call me and I'm gonna forget about them. I'm gonna be able to find their information, and we can kind of pick up where we left off when the time is right. All right. Any questions? Ideas? Other objections?
One that I've heard is, you know, people with questionable credit, they're like, well, I don't really wanna go down that, I'm afraid if we start it, then it's gonna hurt my credit even more than it already is. Is that a reality or is that a myth?
So a hard credit inquiry, it can impact your credit. It is something that goes into your overall credit score, but not anymore, and it's gonna be kind of a wide range, than 5 to 15 points. A lot of that is gonna depend on the other data that's reporting. If it's somebody that doesn't have any credit cards, then an inquiry might have more weight than if somebody has other trade lines and other things to report where they may only see an impact of about 5 points. Ultimately, over time, especially with new construction buyers, we might be pulling 2, 3, 4 credit reports, and we even see their scores improve by them not paying off points. So in the long run, a hard credit inquiry is not going to take your score any differently than, you know, if you were to wait and then we want to pull your credit the day before closing or the day before you want to apply and then you got a problem. So it's really not not anything that I think is a substantial impact. Nate?
If you have somebody who has judgments, in other words, they owed somebody money, they didn't pay the money, and that creditor filed a judgment, and there are multiple judgments out there, something can happen where the creditors who are owed money can see judgments starting to get paid, they go file theirs. So it is possible that if they have a bad credit score, it could get worse, depending on their overall situation. So it's not as easy as a yes or no. Sure.
But for your general person, it's not gonna take you from a 780 to 720.
Well, I've always told people, look, if the goal is ultimately to buy a house, we gotta do it at some point or another, so,
That's right.
you know, and it's gonna,
If I
if it
fail
hurts you,
to
it hurts you.
prepare, you're preparing to fail.
Well, you're raising your credit score for this, you're gonna benefit with credit cards and car payments and things like that with a better score. So it does help out in a larger scale than just this transaction.
Also, you can't help but fix it until you actually get to look at it.
Right, yeah.
Yeah, I was gonna ask just about, home equity lines. I've got a lot of people who have a lot of equity in their homes, but don't have a lot of cash in their pockets, still to kind of make things work. Can you just kind of talk about some strategies with that a little bit?
Yeah, absolutely. So, like Kevin said, if somebody had their houses were 400, they owe 200, they want to buy before they move, their debt to income ratio is low enough, we'll connect them with a banker, get a home equity line. That could do multiple things. That could allow them to maybe do things they need to do to their house to get it listed and have it ready when they need to sell, and also have it accessible for down payment when the time comes. Having a home equity line open and not having a balance on it, they're not paying anything. But they have that tool there if the house pops up, and they can be ready to go. As long as we are factoring in that potential payment once they do draw on the funds and it's not impacting qualifying, it's a great way for them to access down payment, and not have to get a gift or pull from retirement or do all the things that people are doing to be non-contingent these days.
How long
It's a
do you
great
have it
tool.
open?
With Towne, 6 months, to have it open without having, Towne covers, well, without any prepayment penalties, 6 months to have it open. Doesn't need to have a balance, but it needs to be open for 6 months.
And if you open it and never use it, is there a penalty?
And it's a
Do I-
good strategy for.
If you never use it, there's no penalty.
Yeah.
Yeah.
It's accessible for the first 10 years, so you can borrow against, pay down, and it's always there. And it's a good strategy in the event somebody's trying to move up or move down and they got a property to sell, but they wanna do a bridge loan. Bridge loans are available, you do them, they're just cost intensive. HELOCs are a much easier way to kind of access that equity, at least in my view.
Yeah, and there's other ways too. We can do it, a HELOC on the new property, and that serves a couple purposes. The main one we see that for is if somebody's trying to buy a $900,000 house, but they don't have the 20%, or they're in the jumbo threshold and they need to get back to the conventional loan threshold. We'll take a conventional loan for $700 for easy math, and then add on a home equity line for $100,000. Then they're having to come to the table with $100,000 that's less than 20%, and then once they sell their house, they can pay off the home equity line on the current home and still have it if they ever wanted to put in a pool or do whatever. So there's different strategies to use it. There's also other ways to kind of get their first loan amount down lower. So earlier in the year, we were offering it because the company we work with was capping interest rates at 7.5% on the home equity line. Whereas now, most home equity lines are based on prime rate, which is over 8.5%. And so we were offering that as a way to, okay, your mortgage rate is pushing 8%. Let's borrow a little bit more on this HELOC. That gives you some flexibility in programs. Borrow less on your permanent mortgage. That way, once you pay off the HELOC, you're living with the 30-year, lower payment than you otherwise would, and that eliminates the need for what's called a recast. That also is an option for folks. It doesn't really improve or impact buying, but a recast is not hard to do, and it's a small fee. But sometimes it's easier just to open that HELOC, take $200,000, pay it off, and not have to do the recast because you're already paying the lower payment. The recast, you're living for 6 months with a higher payment, and you're not supposed to pay it off before. So lots of different strategies, not necessarily to improve qualifying or overcome, more for the contingent, non-contingent scenario and just overall strategy for cash flow.
This might be a tough question, but, what do you tell people when they say, Abby, what are interest rates gonna do? What's the future of that?
Say, I wish I knew.
Me.
One of three things, they're gonna go up, they're gonna come down, and they're gonna stay the same.
I really say I wish I knew. If there's anything in the immediate, like if we know that, okay, the Fed's meeting today, or like there's something like that that we know that we might see a change, I can speak to that, but long term, I read a lot, I listen to a lot of videos, I pick whoever's opinion I like the most that day, and I regurgitate it. That's all we can do, because there's a lot of experts that have all different opinions, and how do we know who to believe? And a lot of times they're all wrong. So, kind of just say that.
I think saying nothing is probably the best thing,
Yeah.
is we don't know, and again, back to the things you can control and things you can't. You don't have any control over that.
Yeah, let's make a strategy within your comfortable budget and help you get there.
I like telling people, hey, this is the, if you buy right now, this is the worst it's going to be, cause you're
Right.
locked in for 30 years. The only thing you can do from here is go down, so you can
Yeah.
refinance, but rates go up, and thank God you bought when you did.
Yeah.
And for all the people who thought that rates were, when they were in the 4s, and they're going to 5, and they're too high, those people are all sitting there, kind of eating crow right now, so it's,
Yeah.
you gotta be in the market to take advantage of it and time it up.
Yeah, there's no better feeling than when a buyer is emailing you and you're pricing out rates daily for weeks, trying to figure out where they wanna lock or what they wanna do. They finally decide to lock in, and you're like, the weight off your shoulders, and you're like, this is the worst it's gonna get. And then maybe you can pull through and do a credit rescore and get their pricing better, and you can actually, apply some strategy once they're locked, or once we kinda know where things stand. But, waiting and floating, it's just so much risk, and we really don't know what's gonna happen. Any other questions?
I'll just say with the first time home buyers as well, to get locked in and keep in mind this is your first payment, and hopefully you're going to make more money as you age in your job or occupation, and that payment, which may be scary right now, won't be so scary in a couple of years, but you'll be glad you made a choice when you did.
Yeah.
What about, what's the interest rate on your current rent payment?
That's always a good one.
100%.
All right, y'all, well, thank you.
Yeah.
Call us if you need anything.